Hello, good afternoon, everybody. Welcome to Marcellus's webinar. This time, it's not on any of our portfolios. It's more about how we see the macro environment, both from an economy standpoint as well as markets. To tell us more about that, I have with me my colleagues, Saurabh Mukherjee, who is our CIO, Nandita, who's our economist, Krishnan, who heads our quant investing. Saurabh and Nandita have been crisscrossing the country over the last few months, trying to get a sense of what's happening on the ground beyond what the media reports or what the numbers suggest. So they have a lot of interesting takeaways for us to share and explain and unravel the whole correction that we're seeing in. So without much delay, I'll hand it over to Saurabh to take us through the macro piece. Over to you, Saurabh.
Thank you. Thanks, Pramod. So, folks, we'll divide and conquer here. I'll talk about what I think is happening in the economy in terms of things that are going a little south, things that are going a little soft. Nandita will then talk about why there are some reasons to be optimistic that at some stage in the next 6 months, six quarters or so, Nandita will talk about why over the next 6 quarters there are reasons for optimism that there will be an economic turnaround at some stage in the next year and a half. Pramod will then discuss valuations. I think big concern for us today is valuations. And finally, Christian will give you way ahead. He'll give you what you can do after this webinar rather than just listen to us discussing the economy. Okay, so we'll start with what's going soft in the economy. Where are we? Where are we going? All right, Nandita, if you could just move forward on the slides. So, folks, if you look at the earnings growth piece, right, this is quite unprecedented. If you leave aside Lehman Brothers and leave aside Lehman Brothers and COVID, exceptional exigencies, it's very hard to remember this sort of dramatic earnings slowdown, right? This is MSCI India, but Nifty is similar, right? In basically 5 quarters, earnings growth has slowed down from 30% plus to around 5%. So the 5% on the extreme right here refers to the quarter to September. Once the quarter to December earnings are ready, I think it'll be similar, 5% ho gaya hai. Dramatic slowdown. But the perplexing thing is, in spite of this sort of earnings slowdown, valuation multiples still remain elevated, right? These forward multiples that you're saying, the yellow line in the niche wala panel, this yellow line, the forward multiple of 22 is amongst the highest in the last 25 years or so. And in light of this sort of blistering slowdown in earnings, right, this sort of remarkable slowdown in earnings, to see the valuation multiples hold up is perplexing. Part of what we'll try to unravel for you, part of what we've tried to unravel for ourselves is, why is this happening? Given that we have a clear cyclical downtrend in the economy, why have the valuations been so stubborn, right? So to understand that, I think we need to go back a little bit. I think what happened to India in the aftermath of COVID had 3 unique factors, right? There were 3 unique things that played out. And the first unique thing was that all of us on this call were basically locked up at home for 18 months, right? Not too many other countries had as strict a lockdown as India did over those 18 months. And as a result, people saved up a lot of money over those 18 months, right? There's only so many, takeaway meals you can order, and there's only so many OTT movies you can watch over 18 months, and people saved up a lot of money. And as a result, when the lockdown ended, say around September 21, you can see on both the charts, the left-hand chart is economic growth, the right-hand chart is what is called CapEx, right? CapEx is investments by corporates. In both the charts, you can see roughly from September 21, August, September 21, through to August, September 23, we had 8 quarters of blazing economic growth, right? There was genuine high-octane economic growth around the 7.5–8% number. That's enough to get everybody excited, right? So the first thing to note is, because of the extreme nature of our lockdown, we had a extreme bout of revenge spending in the 8 quarters that followed, a revenge capex as well in the 8 quarters that followed. The economic growth took off, and everybody got wildly excited about that, and they thought that some new paradigm is here, some new normal is upon us. The second remarkable thing about what happened during COVID was the amount of investment. The foreign investor activity kicked it all off. So if you look at the bottom left ka chart, look at FY21 and look at that big red bar. That's foreign money pouring in. That's $40 billion of foreign money pouring in the year ending March 21. The Federal Reserve did $10 trillion of note printing, and out of that, 40 billion ended up with us. Once the foreigners left, you can see the foreigners then exit in F22. The Indian retail investor took over, And what you then had is 4 consecutive years of 30, $40 billion of retail money coming in. So the first factor was 8 quarters of blistering economic growth. The second quarter was billions of dollars of new money coming into the market. Initially foreign money, but then subsequently domestic money. As a result, every year, 30, $40 billion of fresh equity capital pouring into the stock market even today, even though we are the fifth largest market in the world, we're still a reasonably small market. Over the course of 4 years, to get the best part of $200 billion is enough to get everybody excited. So it's not just economic excitement, you had financial excitement as well, the bottom left side. And the final piece of this trifecta, right, this trinity of remarkable things that happened after COVID was the media narrative, the popular narrative, both in print media, broadcast media, but also in social media, that some sort of golden age is upon us. So Nandita did a search of the term Amrit Kal, and you can see in 2023, right, the term Amrit Kal became a part of the daily lexicon in our country. People genuinely believe that some generational changes happened and kuch bhayankar naya hone wala hai, right? So three things which got everybody excited: 8 quarters of blistering economic growth, uh, 30, $40 billion banging into the stock market each year, and this popular narrative in media that some golden age is upon us, right? Now, all of that obviously resulted in valuations going through the sky. Now, we are a free market economy. As with all good things in a free market economy, they tend to be cyclical. And as these three effects wear off, the economy is normalizing. So first off, if you look at profit margins, right, all that capital that came into the stock market. Remember, capital will also finance new capex. It'll finance new business creation, new plant creation. Naturally, as competitive intensity picks up, those new businesses that were set up after COVID kick in. Operating margins, if you look at the top left chart, you can see operating margins are going back to where they were before COVID. There's nothing wrong with that. This is actually what you need in a competitive economy. You had elevated operating margins for a couple of years after COVID because of the supply side issues that COVID had created. As those supply side issues dissipate, as lots of new capacity comes on stream, whether it's in our type of industry, in building materials, in manufacturing, in IT services, as new capacity comes in, operating margins are going back to where they were before COVID. And the right hand side, the capacity utilization coming back is in a way the underlying business driver of operating margins normalizing. Capacity utilization plunged during COVID for obvious reasons. It's come back up. One thing that we'll get back to is notice that the post-COVID capacity utilization, right, it's actually a little below pre-COVID, right? That's a little perplexing. We'll give you our thoughts on why this is happening. Why is the new normal on capacity utilization a little below what it was pre-COVID, right? But by and large, the economy is normalizing, and whilst not only supply side factors like capacity utilization, even demand side factors are normalizing for a range of products. We put here FMCG volume growth, car sales volume growth, and we put consumer durables, right? We put three products, but you could put multiple other things. You could put building materials on this slide, right? The growth rates are going back to what they tended to be before COVID. The post-COVID 8 quarters of blazing growth are fading away. We're normalizing as an economy, and therefore both margins and growth are going back to what they were in 2019. 2019, the economy was in reasonable shape, but it was a fairly sedate economy in 2019, and we're returning to a sedate economy, right? Now, all of this is pretty cyclical. There's nothing dramatically untoward about this. This is how free market economies function. You get 2, 3 years of great growth, then you normalize, and then you get a couple of years of more sedate growth. However, there are three factors that have kicked in this era between 2020 and 2025, right? So we went into a boom, we've come out of a boom, but in this intervening 5 years, I think three things have changed about India. And these three things, I think, will cause India some degree of difficult adjustment over the next couple of years. I think the first thing to be careful about is there's plenty of data from the RBI that middle class households are struggling. So the first bit of data from the RBI is the RBI publishes lots of excellent data, but I think amongst everything that we publish, I think this chart and the data that the RBI publishes on what they call net household financial savings. What is that? Net household financial savings? This households ka saving minus households ka borrowing, saving minus borrowing, and they divide that by GDP. And it's a good measure of how much a household is actually saving. You can see that ratio of household savings is where it was 50 years ago, right? After you can see it rose for 50 years from the emergency in 1976, 77. For 50 years, household savings rose as a percentage of GDP. But because of the stress caused by COVID and the aftermath of COVID being tricky for middle class households, those savings have been dissipated, and we're back to very low levels of household savings, right? Now linked to this is pain on the households ka P&L, right? The day-to-day revenues of households, income of households minus expenses, that picture is looking increasingly tough. The first aspect of that, first driver of why households is P&L, why households is revenues less costs are causing the pain is income tax itself. So over the course of a generation, over 25 years, you can see what's happened to individual income tax, right? Individual income tax has gone from being 1.5% of the economy to 3.5%. And this shouldn't surprise anybody, right? There are basically 4 million, there are 40 million taxpayers, the 40 million income middle class taxpayers who account for 75% of India's income tax collections, right? There are 640 million voters in India. Out of 640 million voters, only 40 million are middle class taxpayers. As I'm sure many of you know, many of those middle class taxpayers actually go on holiday during elections. So from an electoral perspective, even if 2-3 million middle class voters turn out to be vote, from a political perspective, they really are far less significant than the other 637 million Indians who are non-middle class, don't pay tax, but are politically powerful. And therefore, multiple generations of Indian politicians, the bottom left chart is showing you multiple generations of Indian politicians have said the middle class is a bakra, we can tax, and the growth in tax burden on the middle class, the income tax burden is quite remarkable. It's just, when you look at that chart, you're going to feel that this is not sustainable. That's the first driver. Second driver has been inflation, right? Not just, we've used food inflation here. Nandita's shown you how much food inflation has gone up. Basically, food prices have more than doubled in the last decade. But you could also, that black line, the food inflation line, also reflects, say, rents. It reflects school fees. It reflects medical insurance costs. It reflects general cost of living going up. And unfortunately, for middle class households, even the expenses have doubled. The cost of living has roughly doubled in a decade. Their salaries haven't, right? So again, using income tax data from the government, what we have done is the red line. The red line is showing you that typical middle class family's income hasn't grown in a decade, even though expenses have, which means in real terms, middle class household is only half as rich today as it was 10 years ago, right? Now, what is happening here? Why are middle class household salaries not going up? I think a big part of this is automation, right? We've written about this. We'll write more about this. Automation, AI, robotization of factories means that supervisory and managerial workers, the extreme right chart, right? This is from the annual survey of industries. This is a highly respected government survey. The annual survey of industries is telling us that there's far lower need today. There's far lower need today for middle management roles in corporate life, whether that be in offices or factories. And those were a staple source of middle class employment, right? Middle management jobs in banks, in factories, in media, in hospitality. The rise of technology, automation, and robotization is robbing the middle class of those jobs. And that in turn is squeezing middle class incomes. Added to that is the tax burden, the extreme left-hand side. Now, if middle class incomes have halved in real terms, but the expenditure hasn't, right? We haven't seen any FMCG company or auto company say कि मेरा sales ज़्यादा हो गया, right? Middle class incomes have halved in real terms, but volumes for these companies, auto, FMCG, consumer durable, haven't halved, which naturally implies that middle class families have borrowed a great deal of money to finance their standard of living, right? And that's again back to RBI data. This is everything on this slide will be RBI data. These are charts from the RBI, remarkable stuff that the central bank puts out, right? So if you look at this top left chart, the yellow bit is loans being taken to finance day-to-day consumption, right? So yellow bit is loans being taken to finance day-to-day consumption. You can see on the left-hand side, on the 2019 side, the pre-COVID era. In the pre-COVID era, households were financing around 40% of their consumption using consumer loans. But as you come to the right-hand side, you can see that 40 has gone closer to 50%. The yellow area is getting bigger and bigger. More recently, in December, the RBI published even clearer data on this. The RBI broke up Indian households into subprime and superprime. Subprime are people with low credit ratings. It's roughly 45% of the borrowers. If you look at those those poorer people, the subprime borrowers, 45% of borrowers. You can see there, then that blue in that pie chart, the blue area is consumption, loans being used to finance daily consumption, right? So we've got roughly half our borrowers using their loans to finance their daily consumption, right? And that is the makings of a debt trap. When you get poorer income, lower income people, right, subprime borrowers using borrowings to finance daily consumption, it's highly likely they'll never be able to repay this. And naturally, this sort of borrowing stress is then showing up in the delinquency data. Right before we get to delinquency, another remarkable chart using RBI data. Right, consumer borrowing, credit cards, retail loans used to be just 4% of the banking system's loans a decade ago. They are now close to 11%, right? So the banking system has gone to town lending to middle class people. Part of this is because of what happened in 2015. In 2015, the then RBI Governor Raghuram Rajanji, he announced something called the Asset Quality Review. He basically forced the banks to own up to the rotten loans they had given, but they were not admitting to having given, right? So he made the banks recognize their rubbish loans, and many of the banks, private and public sector, went through 3 or 4 traumatic years as they had to cough up and they had to own up to doing rubbish lending in the preceding 5, 6, 7 years. Now, one downside of that traumatic period for the banks was they swore off they swore off capex, they swore off corporate lending. And if the banks don't lend to corporates, how else will they grow? So they'll focus on lending to the middle class. So the banks' jobs, the lenders, banks and NBFCs in the last decade have lent more and more and more to the middle class. And the middle class have happily taken those loans, given that their real incomes have halved over the last decade. The result is the bottom right chart, where again RBI data is showing significant buildup of stress, right? So the left-hand side, in the bottom right chart, the left-hand side is secured assets, right? So home loans and LAP, they're still in decent shape. Those are secured assets, good quality assets. But as you go to the right-hand spectrum, those are unsecured. By the time you get to consumer durable and credit card loans and personal loans, those are effectively by and large unsecured. I know a consumer durable loan is secured with a washing machine or a fridge, but that security actually isn't worth a great deal, right? So personal loans, as I'm sure everybody would have read, is already a disaster zone, right? Credit cards, this chart suggests that pressure has eased, but this chart has data till March 24. Subsequent data is suggesting further deterioration in credit card NPAs. Consumer durable loans, trouble is afoot. Two-wheeler loans, surprising deterioration. This deterioration is continuing even in this quarter. Auto loans have held up, but I think that'll be the next wicket to fall here. Auto loans will be the next wicket to fall here. And this chart, I think, should worry all of us, because a big part of the consumer middle class, the lights are already flashing amber, if not red, on what's happening here, right? So the first big issue I think we need to keep in mind is the middle class is in a degree of pain. The balance sheets are stressed. The recent income tax by the FM is the right step. It'll partly put a band-aid on this, but the issues are fairly deep here. Let's move forward. Right. So the next challenge, folks, is what's happened in our stock market, right? This is quite remarkable. I haven't seen this happen in any country in my 20 years of working in finance, right? So if we look at the first chart that Nandita will beam up, this is RBI data on savings account growth in our country. Savings, remember, a bank does 2 types of accounts: current account, which is, say, Marcellus putting its savings, Marcellus's savings with HDFC Bank, and savings account. Savings account is not Marcellus. Savings account is Saurabh Mukherjee or Krishnan's savings with HDFC Bank, right? So it's called CASA. Ka is current account. SA is savings account. Savings account is the lifeblood of a banking system. That's the stuff that the bank needs to lend to SMEs, to give you home loans and so on. You can see again over a generation, over 20 years, savings account growth has trended down. Now, by itself, that's not bad, right? If banks are using their savings to buy life insurance policies, build a home, finance education, that's at one level a good thing, right? But increasingly, what the data from now SEBI and AMFI suggests is that customers are drawing down their savings account to not just invest in the stock market. The right hand side chart is mutual fund flows, right? In the right hand side chart in mutual fund flows, the red is small cap, right? Customers they're drawing down their bank balances to load up on mid cap, right? And that red becomes redder and redder. As you go to the extreme right, you can see the blue disappears. Large cap funds, nobody wants to invest in, right? Large cap funds, as Pramod will highlight, the valuations are pretty reasonable. In some of the most expensive valuation scenes in Indian history, Indian retail investors are putting their life savings in mid cap funds. It actually it makes you to sort of rethink capitalism. I know capitalism is the main way the world has grown, but this sort of thing is quite heartbreaking. Basically, you can literally see in front of you households draining down their savings account, sticking their life savings into mid cap funds at some of the most expensive valuations ever seen in the last 20-25 years, right? And the other corollary of that, right, if this weren't bad enough, is that the banking system is running short of deposits, right? Because the banking system is running short of deposits, credit extension by the banking system has slowed down. So credit growth, which a decade ago was around the 15% mark, right? If you look at that black line, a decade ago, credit growth was around the 15% mark. It's gone up and down, but by and large today, credit growth is around the 10% mark. Given that inflation in India is 5, that means real credit growth is 5%. If real credit growth in a relatively poor country is 5%, economic growth can't be that much higher than that, right? So this is the second challenge, I think, that the authorities are aware of this. This is a Hobson's dilemma. Either the authorities deflate the stock market and incentivize houses to take their money out of the stock market back into the banking system so that the banking system can extend credit and grow the economy, or the stock market carries on booming, but the economic growth stays weak, and that means higher and higher P multiples. You know how that's going to end, right? So this is a Hobson's dilemma for the authorities. They're well aware of it. Third problem, right? Third challenge is not created by us. This is imposed on us by the United States of America, right? So in every decade, India will have two different types of slowdown. One type of slowdown is where the dollar behaves itself, and the RBI can then print money and reflate the economy. The RBI can cut interest rates, reflate the economy by chapoing money, right? That's a benign slowdown. We saw something akin to that in 2016, right? In 2016, the economy slowed down, but the dollar behaved itself, and therefore the RBI was able to reflate the economy in 2017, right? But a more painful slowdown is where the dollar misbehaves. The dollar appreciates. And what the top left chart shows you is whenever the dollar appreciates radically, the RBI sucks liquidity out of the system. The RBI sells dollars, buys rupees, and drains currency out of the system. Right now, that's great to protect the currency, but if the RBI drains liquidity out, it hits the economy pretty hard. It tightens the money supply. Right now, one reason the RBI is having to do it is the right hand side chart. The right hand side chart shows that in 2023, India crossed an important Rubicon. 2023 was the first time in our history, at least first time in the last 20-25 years. Maybe it had happened in the 90s. We don't have the data on that, I have to confess. But in the last 25 years, 23 was the first year where foreign inflows into India, foreign portfolio investment, the stock of foreign investment exceeded India's FX reserves, right? So that Wrigley line on the top right-hand chart, that Wrigley line crossing 100% says that the stock of foreign portfolio investments in India is now significantly higher than the FX reserves of the country. That is tricky because that means that as the FPIs leave, the RBI will have a really hard task using its reserves to defend the currency. Using its reserve to defend the currency in turn will drain liquidity out of the system. And if you see the next chart, and let's just hit enter another time, you'll see that the RBI is having to do that pretty consistently over the last 12 months, right? So system liquidity, think of liquidity in simple terms as broad money supply. So when the rupee is under pressure, the RBI sucks out money, tightens money supply, right? And that's what you're seeing on the bottom left chart. Tightening money supply in an economic downturn makes the downturn more painful. And one side effect to that is the commercial paper market. Commercial paper are 1 year, 2 year bonds issued in the money market in Bombay. A lot of this is issuance by NBFCs, right? So firms like a Bajaj Finance or a Chola will issue paper in the commercial paper in the Bombay money market and use that to lend money. So if system liquidity is tight, i.e. money supply is dried up, then commercial paper issuance dries up, which means the ability of the NBFCs to finance economic growth is in turn challenged, right? So the preceding slide was about the banks' ability to finance economic growth is getting challenged. This slide is about NBFC's ability to finance economic growth is being challenged. These are not unsolvable issues, but these are tricky issues, and these suggest to me that we will have a few quarters of muted economic growth. But there's good reasons to hope that it will be a few quarters and a few years. I'll request Nandita to elaborate upon those.
Right. Thank you, Saurabh, for explaining that very succinctly. Be that as it may, there are some dark clouds hovering over the Indian economy, but there is definitely a silver lining. And we have identified four rays of hope, or those four silver linings, which are currently there in the Indian economy. The first one is obviously depreciating rupee, making Indian exports competitive. Now, standard economic theory suggests that as rupee depreciates or as any currency depreciates, the exports of those countries become more competitive in the in the world markets. So that is precisely what is happening. The rupee has depreciated by around 5% since the last 12 months, and we can see in the data, which is shown in the screen here on the left hand side, merchandise exports have sort of picked up in FY25, especially after August, September, and October, November, until when we have the data for merchandise exports has really picked up. This is not the case so much in services exports because IT exports, IT services has not really picked up, and we expect that to happen as time goes by. But however, the growth here is also modest. Now, within merchandise, if we break down, we see pharma exports. The YOY growth has again not picked up that well because here the China plus one is taking more time to kick in. But we expect that to happen, especially given what Donald Trump is doing right now and trying to sort of put up all the tariffs over here in pharma products, which will give us a natural benefit here, and this should pick up. The most benign picture is painted by the electronic and software exports within merchandise exports, which have picked up really well. And a key case in point is the iPhone exports now, which are expected to cross rupees 1 trillion or roughly $12 billion in the fiscal that will end in 2025 March. Which is a key indicator that government's PLI push, that is the production linked incentive towards electronics, as well as the depreciating rupee, has had the most benign benefit to this sector. Second, as a note here, obviously the exporters are doing really well with the depreciating rupee, but what it also brings with it is a blessing in disguise for investors like you and me. This I say because whenever the rupee depreciates, the Nifty falls, and that opens up a very good window for investors to put in their money into the market at attractive valuations. Given where we are, this we think is going to bode well for investors going forward. The second ray of hope that we've identified is that the China plus one opportunity, especially catalyzed after Trump's victory in the 2024 presidential elections in the US, is likely to create a roughly US dollar 300 billion opportunity for India. So what we did over the last 1 to 2 years is that we identified sectors where India could benefit from the China plus one effect kicking in, given that the US is obviously perpetually in a tussle and more so now than ever with China, given tariffs and all the other issues that it has, geopolitical issues. With that in mind, we identified three sectors. The first one, the three sectors being smartphones, active pharmaceutical ingredients, and medical devices, which collectively are expected to bring in around $300 billion of opportunity over the next 10 years, which is roughly 8% of Indian GDP. This is significant. So the next ray of hope that we see is that non-urban consumption is likely to make a comeback. In fact, we can see that it is already making a comeback. Why do we say that? There are a few tickers that we can identify and understand which sort of predate the consumption picking up. The first one being National Rural Employment Guarantee Act, which is the NREGA employed numbers as well as the wages going up. So from July onwards, we can see that this number has been started picking up, which means that people have more money, more disposable incomes in their hands, which directly translates into higher consumption by these people. And this is typically for the rural folk. The second ticker that we assess is the Rabi and Kharif crop minimum support price, which is the price that the government of India pays to the farmers for their produce, like something for producing wheat, rice, etc. And this we can see is also trending upwards. Both of these indicators mean that people today in the rural area will have more money going forward in their hands to spend. This definitely bodes well for consumption, non-urban consumption going forward. And we can see that tractor production has already started inching up. It's been going up since November 23 now. That was the trough sort of, and then it has started picking up. This is YOY growth. And similarly, we can see that the rural traction has been driving car sales, with wholesale sales were up 4% in November, as well as FMCG in the rural area grows by 60%. So these things have started becoming positive. The fourth ray of hope is basically something that has helped ray of hope number 3, which is that after the June 24 elections, BJP has change tack in the way that they are making policy. Now let's go back a little bit in history for the last 3 to 4 years. What we saw was that post-COVID, the government went gangbusters on capital expenditure, and as a result, went sort of low on revenue expenditure, which is typically subsidies and the kind of rollouts that the government gives out to the people. Now, what happened is that capital expenditure grew by more than 30% in these 4 years, and as a result, obviously, the budgetary allocation also increased. This negatively impacted the BJP in the 2024 general elections, where they lost substantial number of seats in the Lok Sabha elections. In 2019, they had 303, and they could make the majority government very easily. In 2024, that went down to 240, which is below the 272 majority mark. They have learned their lessons, because in the FY26 union budget, which was just presented on 1st of February this year, suggests that they have tried to reduce the income tax burden. The chart that Saurabh showed you in the previous slide showed that the income tax burden on individuals had increased significantly over the last decade. It is now coming down. It is expected to come down in 2024-25 after the the benefit that the government has given, and more so in 25-26. Similarly, if we look at the elections, post general elections that happened in May 2024, which is the Haryana election in October 2024 and Maharashtra election in November 2024, we saw a lot of the things that the government, the BJP promised in its election manifesto was related to revenue expenditure, not capital expenditure. Something like Ladki Bahin Yojana in Maharashtra, where every woman gets rupees 2,000 per month, regardless of where they come from. All qualifying women get it. Similarly, in Haryana, they had a scheme called Ladu Lakshmi Yojana, and all such schemes started gaining traction. So these are the changes that we are seeing. These are the 4 rays of hope that we are seeing. I will now request my colleague Pramod to take up the implications that these will have going forward as investors.
Thank you. Thanks, Nandita. So, folks, as you heard, clearly we're going through a cyclical slowdown at the economy level, which is also showing up in the earnings slowdown for listed companies. Over the last 3 quarters, the deceleration in earnings growth has been fairly sharp. This is a chart for Nifty, which is showing the fundamentals. The fundamentals, the blue bars are the earnings growth. As you can see, it's come off very sharply in fiscal year 2025. And from the looks of it, it could continue to decelerate into FY26. We can't really pinpoint when the recovery will come. Alongside that, you can see the gray line, which is the return on equity, which is again a fundamental characteristic. While it has recovered from the COVID lows, if you look at it, it's significantly below its historical average. It's hovering around the 14% mark now, when it was comfortably above 15% in the past. So combining with a slowing earnings growth and a modest ROE, valuations, which are depicted by the price to earnings ratio, which is the red dashed line, as you can see, it's close to its all-time high. Now, fundamentals significantly below history and valuations being all-time high don't really make sense. Having said that, this is not even the problem, because the picture I'm showing is one for Nifty, and the problem on valuations actually is not so much in Nifty. In fact, Nifty has a significant weighting to sectors such as banks, oil and gas, metals and mining, and PSUs. And maybe barring PSUs, the other sectors haven't really participated in this rally and are not the real picture of the froth in the market. To tell us what the froth in the market is, I'll request my colleague Krishnan, who wrote a beautiful blog about 9 months ago. In fact, he manages the quant portfolio Meritor, where he tilted his portfolio significantly away from small and mid caps towards large caps. So I'll request Krishnan to show this or talk us through this stark gap between valuation of large caps versus small caps. Over to you, Krishnan.
Thanks, Pramod. Nandita, if you can, yeah. So I think it's of no surprise, right, to anyone if I say that in India, small cap returns are cyclical, right? Definitely more cyclical versus the broader market, right? And there are obviously fundamental reasons for it, simply because, small cap companies, whichever way you define it, they are younger companies, more untested business models. And also, obviously, even in terms of their shareholdings, they're not widely held. So, so various reasons, right, why small caps tend to be more cyclical versus, say, large caps, right? So what we have shown here, we are trying to show this more, we're not showing any valuations here on this chart. Essentially, we are trying to show, what is the market cap contribution, right? If you go by the AMFI categorization of, the size segments, right? So the top 100 large caps, the next 150 mid caps, and the bottom 250 small caps, right? So, the small caps here on the left chart are, the red area chart. The large caps is the blue line, is the blue area chart, right? And you can see that, it's the small cap and the mid cap are progressively now contributing to a larger portion of BSE 500 or the top 500 market cap, or the total market cap as a whole, right? And in fact, this number today, large cap contribute close to 66% of the market cap, and this is as of 31st January 2025. A decade back, this number was around 74%. So in a matter of 10 years, large cap as a percentage of, the top 500 market cap, or the market cap of the top 500 companies, that has gone down from 74% to 66%. Meanwhile, for small caps, this number has gone up from 7% to 10% today, right? And again, that ratio, if you just plot that ratio between the market cap as a percentage of your total, the market cap of 500 companies for large caps, as a ratio, right? Large caps in the numerator and small caps in the denominator. That's what we are trying to show on the right. And you can see that if you look at, the 3-year average number or a 3-month average number, in both cases, this number has been trending down, right? Because small caps now contribute to a larger portion of the market cap of the top 500 companies in India. So a decade back, this ratio was around 10x. Today, this ratio is around, the 6.6x, as you would see. So moving on, this again, if you think about, again, more in terms of, again, how these translate in terms of returns, again, the cyclicality kind of, comes out more clearly when you look at, the rolling 10-year numbers. And what we are showing here in that blue line is, you can see that the blue line is obviously far more, cyclical, or, it varies far more versus the gray line, which is your 10-year rolling Nifty returns. The peaks, the small cap returns peak every, 3 to 4 years. This time it's obviously taken a bit longer. The last peak you can see, was 2018, somewhere around 2018, just before, I think there was a mini market crash due to the LTCG change, the long-term capital gains tax change. And today, just in 2023, I think we kind of reached similar cyclical, return, the 10-year return numbers. But so what's happened is, again, what's also contributed to this divergence is over the last 3 to 4 years, especially post-COVID, that, because of the relentless selling, by FIIs, and because large caps are more heavily held by FIIs, large caps haven't had the opportunity to appreciate as much as small caps, right? Which is what you would see in that gray line kind of trending down, and the blue line, kind of just going up and up and up, right? Till we got to the correction over the last 1.5 months. And in fact, when you look at the 10-year return for Nifty, it's kind of converged with the 10-year earnings growth, the EPS CAGR, which is around 10%. So in a way, I mean, yes, I mean, even if you look at Nifty, what Pramod said, you might argue that it looks, the valuations are above average when compared to history, but again, they are nowhere as extended as as the small and mid cap segment. Over to you, Pramod.
Yeah, so the skew is not just between large caps and small caps, right? Whenever we have an extended rally like we saw post-COVID, particularly in 2023 and 2024, we also see another pattern where the market rally skews away from quality. Now, we use forensic accounting or accounting quality as a proxy to assess this. And as we've talked about it in our books, Diamonds in the Dust, there is significant correlation between long-term stock price returns versus quality of the business. Now, the quality of the business has multiple parameters, including accounting quality, business quality, which is return on capital. But what this slide shows is, Nandita, if you could just proceed to show if you can focus on the chart on the bottom left, what we're seeing in calendar year 23 and calendar year 24, the red bars are bigger than the blue bars. The red bars are returns from stocks which fall into the bottom 4 deciles based on accounting quality in our proprietary forensic accounting model. Remember, we've been talking about it. We've been using this model for the last 15 years. It has held us in good stead in terms of avoiding most of the poor accounting quality firms. Many of them, the stock prices have unraveled massively in the 2018 crash. And I reckon some of them are unraveling as we speak. This is typical in a roaring bull market. Investors generally are more open to taking risk. They move away from quality, and that's clearly showing. But this is mean reverting. Every time you see significant outperformance of the red bars, the ensuing few years, you will see the blue bars making a big comeback. The red bars turn negative. So this is also a classic indication that the market is overheated. It also gives us a sense, just like you have to be invested in equities. What Krishnan's data showed was, while small caps have delivered strong returns over the last few years, it has also resulted in valuations being excessive, and therefore the natural conclusion should be, switch from small caps to large caps or reallocate. Similarly, if you have stuff in your portfolio, whether funds, PMSs, direct stocks, which have made a lot of money, but you're not comfortable about the quality, these are times when quality can be a good safe haven. Now, that leaves us with the question, what should we do? What should investors like yourself do in this market? I know there's a roaring debate happening on social media and elsewhere about whether you should stop your SIPs, whether you should stop investing in small cap or withdraw all your small cap investment. Whereas there is another school of thought which believes in it is all about time in the market, not timing the market. Stay invested. There are few days or months which deliver significant returns. There's no way any of us can know in foresight when those will be. We are in neither camp. We believe what you should do should hinge on asset allocation. There's plenty of financial literature out there now which shows that asset allocation actually drives most of your outcomes or explains most of the variance in your long-term returns, much more than market timing or even fund selection or stock selection. So there is plenty of science behind it. The reason is all about putting together assets which are uncorrelated with each other, which is called diversification. Now, diversification, as we understand, allows you to reduce risk, but at the same time, not compromise on returns. Krishnan has been quite prolific in terms of writing about these in his newsletters over the past few months. In fact, on the back of his work, we are offering our clients and anybody who's interested, a pro bono financial planning and asset allocation service. If you're interested in that, please simply drop a yes in the chat window and we'll reach out to you. In fact, there are a few questions in the Q&A box I've already seen asking about how much should I allocate between equity and debt and gold? How much should I allocate within equities? How much to large caps and small caps? These are very personal choices based on your individual goals and individual risk appetite. So there has to be a tailored exercise for that. Happy to help you do that because we've realized this is what makes you stay in the market and get the best of long-term returns as opposed to trying to be cute and time. Now I'll exit small caps completely and I'll come back. Most of us, will come back after a period of rally. So there's no reason to panic and exit completely. But that ability to not panic will happen only if you've done your asset allocation with some degree of rigor and discipline. So over to you, Krishnan, to take us through why asset allocation is important and a systematic rebalancing is important.
Sure, Pramod. So, why diversify? What's the need for diversification? Why diversify in the first place, right? So why not 100% in equities, right? So obviously, that could be like a very natural question for any Indian investor, right? Given our experience, more recently over the last, say, 3 to 4 years, or even over a longer period of time, right? Because it's, obviously one of the highest return asset classes available to Indian investors. So if you zoom out, right, as what we are showing on this slide is, the 30-year returns for Nifty 500, right? So Nifty 500, again, it includes small mid cap. So yeah, I mean, that's 13% return, which you see, which is the annualized return over the last 30 years. That includes the small mid cap returns also, right? And the 13% is kind of close to our nominal GDP growth rate. So again, no surprises there. But what you would see is there are these periods, right? And this, for example, you can look at the first, period, the 8-year period from 1995 to 2003, where the returns were, kind of, there were almost no returns, right? So, unless, someone, took, or just entered and exited over a very short period, otherwise, point to point, no returns, zero returns, right? Over an 8-year period. Similarly, 6-year period from from December 2007 to February 2014, again, no returns, right? And again, no surprises there. Again, if you look back and for folks who have been around at that point in time, they will tell you again it was just before we got into these extended zero return periods, there was a long a bull market, right? Which preceded this, which took the valuations, above long-term averages, and obviously which was followed by correction, right? And this experience, by the way, is not just, these periods of zero or negative returns in equity markets is not experience which is only true for India, right? There have been such instances globally, whether you look at S&P 500, just after .com, or classic cases, for example, in Japan, right? So in Japan, equity market returns for Nikkei 225 were exactly zero for a 34-year period, right? From 1989 to 2024, right? So imagine this, right? This is one of the major economies in the world delivering 0% return, 0% nominal returns. We're not even adjusting for inflation here, right? Over a 34-year period, right? Which kind of exemplifies again the nature of equity as an asset class, right? So it is an asset class, obviously, where the returns are lumpy, and while returns can go up 20-30% any given year, right? They can also go down, similar magnitude in any given year. So, which again, brings us to our second slide, which is the importance of diversification. And spreading, your investments across different asset classes, right? So what we are showing here is again our asset, your asset return quilt, where we are showing the 5 major asset classes again, which are available to Indian investors. We're looking at Nifty 500 for Indian equities. For global equities, we're looking at S&P 500 in rupee terms. We are looking at gold, we are looking at debt, right, and cash. And again, all of these are investable to various extents. So, and we're looking at this over last 13 years. We've also shown the YTD returns just for 1 month in the very last column here. And what you would see here is there's no one asset class, which figures either in the top or the top 2, right, in each of the last 13 years, right? The leading asset class, kind of the leadership keeps on changing, right, year on year. And what you would realize is, for example, for gold, right? So gold has been at the bottom, or the worst performing asset class for 4 years out of these 13 years. But it has also done quite well in in 3 of those years, right? So if you look at the the top, the years where it has scored on the top, of course, the YTD numbers are just for 1 month, so I'm not counting that. So, and similarly for, if you think about equities, right? So equities, Nifty 500 is on the top for, the 4 out of the 13 years, right? So again, if you if you think about a recent experience, maybe we would think that Indian equities would be at the top, but that's not the case. And cash, surprisingly, is among the top 2 for 4 out of these 13 years, right? So even despite delivering negative real returns, right? So you can still have years where cash can still beat the other asset classes, and it can actually help investors to smooth out the returns. So yes, I mean, what this example, this chart shows is it's worth having exposure to all these asset classes. Of course, basis your circumstance, basis your horizon, basis on your risk appetite, you can decide, right, how much your allocation should be. But all these asset classes should be part of your investment, palette as such. Now, when we talk about diversification, again, people, it's not just diversifying across, all the assets which are available, right? There is, an advantage to diversification only if you are considering assets which are negatively correlated to each other, right? And negatively correlated to each other, and also, you rebalance between those asset classes, right? So diversification only works, if you have negative correlation, and also if you can, follow the discipline of rebalancing regularly. So what what we're showing on this slide is essentially, a hypothetical example, right? Where you just take, 3 asset classes. So we have shown, the zigzag and the zog, so as to speak. The zig and the zog, which is the red and the blue, or the sinusoidal wave, essentially those are all, again, completely in sync with each other. You can think of them as, again, 2 asset classes, or 2 I don't know, maybe funds, or mutual fund categories which are completely in sync with each other. Maybe you are holding 2 large cap funds, right? Completely in sync with each other. So again, if you combine zig and zog, you don't get that advantage of diversification. Why? Because when one goes down, the other is also going down, and even when you rebalance, you're not getting any advantage, right? But zag, even though it has 0 expected returns, so again, 0 returns, essentially it's just fluctuating about a 0 or a particular line, as you can see. If you combine zag, which is completely out of sync with zig, by the way, right, it can give you a smoother ride simply by the dint of rebalancing. Because when zig is down, what you're doing is zag is giving you that extra return, right, which kind of reduces the poor performance of zig, right? So when one asset class is at the top, you are kind of reducing your allocation towards that asset class, and then rebalancing or reallocating towards another asset class which is doing well, and again, that helps you kind of compensate for the
Krishnan,
poor.
even more interesting is the fact that even though ZAG is the lowest return asset class, if you add ZIG and ZAG, the red line and the green line, your returns are no lower than if you add the ZIG and ZOG, right? So
Right.
combining a high return asset class with a low return asset class, which is uncorrelated, does not compromise your returns, right? That's one of the most fascinating aspects of diversification. You're combining 2 assets with low correlation, ideally uncorrelated assets, 2 uncorrelated assets. Even if ZAG has 0 return, as Krishnan is saying, it still gives you not just diversification, not just stability, not just the smoothness of the green line in the right-hand side chart. It doesn't cost you. There is no opportunity cost of adding ZAG. The normal person will say, ZOG add kar lo, ZOG add kar lo. And adding ZIG and ZOG is like putting 2 small cap mutual funds in your portfolio, right? You think you're doing some great thing by adding 2 small cap mutual funds or 2 micro cap mutual funds to a small cap mutual fund. Superficially, that feels like a clever idea. In reality, to ZIG, if you have ZIG, if you have a high quality equity product, what you need to add to that is an uncorrelated product, even if it has far lower returns than that middle wala line.
Exactly. And just to maybe illustrate this, if you can go to the next slide. So this is a more practical example, right? And this is again, something we have discussed in various fora. But again, if you combine Indian equities and in this case American equities, right, S&P 500, Again, this is a classic example where two asset classes negatively correlate with each other. Indian equities, simply because we are emerging markets, we are a higher return asset class, right? Whereas US equities, I won't say they are low return, but somehow lower volatility. But where you get that advantage is, the point which Nandita made in one of the previous slides, where she talked about the Nifty returns being negatively correlated, right, with our currency, right? So just by the dint of as an Indian investor, having a 50-50% allocation or equal allocation to both these S&P 500 as well as Indian equities represented by Nifty 50, you can improve your risk-adjusted return, right? Which is you enhance your returns while also you can also bring down your risk, right? So again, the risk-adjusted return, you can see that when you combine these two, it's it goes up from 1.15, 0.7, it goes to 1.26 here. So this is again the zig and the zog, the zig and the zag, which we discussed in the previous slide. And again, this is a more real-world example, which you see here over the last 20 years.
I think this is quite powerful, Christian. I think a lot of people appreciate diversification for the benefits of its ability to reduce risk, but not many people appreciate that if you rebalance uncorrelated assets, you not only reduce risk, you can actually improve returns. That is what Christian is trying to show in this table. If you see the S&P 500's return over the last 20 years has been 14%. The Nifty's return has been 14.3%. A 50-50 S&P 500 Nifty 50 portfolio showed for illustrative purposes, but rebalanced every year back to 50-50 has delivered a 14.5% return. So even on a return basis, it is superior. Risk-adjusted return basis, it's significantly superior. So, which is what the zig and the zag example also showed. The returns-wise, it matches with the zig and the zog, but the volatility is significantly lower. You're able to sleep peacefully at night without having to compromise on returns. That's the power of diversification of uncorrelated assets. In some ways, this is the holy grail of investing, right? If you're rebalancing uncorrelated assets, what you're doing is effectively you're buying low and selling high. Because when you rebalance, you're obviously cutting down on assets which have gone up, which have veered away from their baseline asset allocation, and you're using the proceeds from the profit trimming to buy an asset class which is in a drawdown situation, which has fallen significantly. And that's what the holy grail of investing is. You buy low, sell high. Rebalancing across uncorrelated assets in a disciplined way allows you to do that. And as this data shows, we've used this presentation in our global compounders portfolio, which is born out of the need for asset allocation for most Indians who have really got no exposure to global markets, US markets, which have delivered pretty similar returns to India over the long run, yet have a very low correlation with Indian equities. Combining that gives you significantly better journey without compromising on your returns.
Yeah. So again, combining Indian and global equities is one example. Obviously there are more examples, right? That we can skip to the next one. So what we are showing here is again, not just Indian and global equities. We are showing Indian equities and gold, right? Similarly, within equities, we are looking at combination of style factors, value, quality, large and small caps, right, which we've already discussed. So again, when you think of each of these asset classes, asset class combinations, at least to some extent, these are they do exhibit low or negative correlation, right? So, and if you have exposure to these these asset class combination and you regularly rebalance, in this case, what we are doing is we are taking, say, a 50-50 allocation or equal allocation towards Nifty and gold, for example, right? And we are rebalancing annually. What we are showing on this slide is basically how much does the rebalancing add value, right? What's the incremental value add from rebalancing, right? So if you just take, for example, the equal allocation towards Nifty and gold, and you rebalance every year, right? That particular portfolio from 2005 to 2024, a 20-year period, right? And you look at the returns of that portfolio versus a simple portfolio where you're not making any change, you're not rebalancing at all, so you're not touching anything, right? what's the value add? So what you see here, the value add is around a 1%, right? Annualized, remember, right? It's not, it might not sound a lot, but it's essentially you're almost collecting nickels in front of the steamroll, right? So it's like just collecting the dimes, but it's worth, each penny is worth it, right? And remember, this is, you're not taking any calls on, you're not trying to time the market, you're not taking any calls on the asset. All you are doing is just maintaining your exposure, your equal allocation towards both these asset classes, and you're just resetting them to equal allocation every year, right? Which is what we are doing. So and again, Nifty gold, again, classic, because, they obviously are negatively correlated. In fact, equity gold, nearly in every country will have low or negative correlation. Similarly, we already talked about global and Indian equities. Value quality, right? Within equities, again, we've talked about this. I mentioned this in the most recent newsletter, but even there's a good reason for that, because value and quality work during different parts of the economic cycle, right? So, value does, value stocks typically do well, or cheap stocks typically do well. When you're coming out of a downturn, quality typically does well. Quality stocks do well, when, things are going really bad, because, they're fundamentally stronger companies. So that kind of contributes to the negative correlation and the rebalance value add, which you see here. And again, large cap and small caps, like I said, small caps tend to be very cyclical in India. So again, that there also you get the the benefits of rebalancing. So diversification combined with dispassionate rebalancing can enhance return while keeping keeping you at the same level of risk, or giving you a smoother ride, while delivering the same return, right? So both kind of can be can be an outcome for investors, very useful. But remember that everything that we have discussed is of should be thought in terms of where you are in your life, where what your goals are, what is your your horizon, or your goal horizon, and also how well you're funded, and so on and so forth, your willingness and ability to take risk. So that's what determines your asset allocation, right? But once you have decided on the asset allocation, having a diversified palette of assets and rebalancing between them regularly can really help all investors. Over to you, sir.
Thanks, Krishnan. As some of you have rightly highlighted, we should also factor in the tax drag of rebalancing. But mind you, Krishnan is talking about annual rebalancing in most asset classes. On a 12-month basis, you move to long-term capital gains tax, while one could argue that not redeeming a fund could postpone the tax, and therefore those funds continue to compound for you. In the long run, those returns accumulated will be subject to tax anyway. On the LTCG, the timing difference is a minor benefit. It's not as meaningful. The key is to avoid short-term capital gains tax, which is quite significant. So, of course, in reality, when you do rebalancing, you will have to take the effect of tax drag on that rebalancing. But in most cases, you will see significant benefits even on a post-tax basis. So that's our message. We are seeing a cyclical slowdown in the economy, exacerbated by the situation in terms of the global scenario, where there are foreign institutional investors who are selling, foreign direct investors, private equity funds, MNC companies like Whirlpool, Hyundai, potentially even LG could come up with an IPO. All this is creating a liquidity, or exacerbating the liquidity situation just when the economy is going through a slowdown, just when the RBI needs to stimulate the economy on a monetary basis. In fact, many of you have asked that question, that retail investors putting money in the stock market should not affect the overall liquidity in the banking system. I guess partly right, but partly if the seller is a foreigner, that money is leaving the
No,
country.
it's even if the seller is Indian. So say if I put money in HDFC MF rather than HDFC Bank savings account, it has a fundamentally different effect. So a lot of people in the stock market believe that if Saurabh Mukherjee puts money in a mutual fund, right, it's the same effect as having a savings account. It's not. The banking system can do far more with your savings accounts than it can do with your mutual fund money. So if I put money in a mutual fund, the mutual fund will have CA balances, but the banking system simply cannot lend CA, current accounts, as much as it can lend SA, savings accounts. And what's happening is, because of retail investors jumping into the stock market, the banking system is being depleted of savings accounts, and that's hurting credit extension. So there's this notion that it doesn't matter banks ka mein hai ya sa mein hai. That's a false notion. The banking system needs savings account balances far more than it needs current account balances. And as the public rushes into the stock market, savings account balances are getting depleted. Current account is holding up because, as many of you have rightly pointed out, via the mutual fund, it still comes into current account, but the banks cannot lend current account money for us, for example, for a home loan. It's simply a different type of liquidity. And I think that distinction.
I think they call it the HQLA, or high quality liquid assets, which cannot be counted towards your capital adequacy.
That's right. So it's a very
to that
fundamental
extent, that's locked up capital. It doesn't increase the liquidity in the system. And furthermore, the last 3 years, foreigners have been net sellers. You can imagine the amount of money leaving the country. That means that overall liquidity is quite significantly low. So with that, we'll bring a call to the end. And like I said, if any of you are interested in doing a personalized asset allocation exercise, we're happy to do that. Just leave a message in the Q&A box. We'll reach out to you. And any further questions regarding the portfolio over the coming few weeks, we'll do webinars on each of our portfolio. I think there's one scheduled for next week on consistent compounders. We'll do one for the mid cap. Because what happens is, in this sort of correction, there'll always be opportunities in the market, right? The correction, the sellers sell everything equally. We are seeing opportunities in the quality space quite attractive. There are lots of work happening at the Marcellus research team. The research team is building up its shopping list, and we will let our fund managers talk to you more about how all of this translates into portfolio action, because at the end of the day, that's where it all benefits. We are all in this to deliver returns and fulfill our financial aspirations. And we'll talk to you more about that in the coming few weeks. With that, thank you, Saurabh. Thank you, Nandita. Thank you, Krishnan. Extremely useful. And thanks for everybody
Thank you
for attending this.
Thank you so much.